How to use the Lemonade strategy for 401k investing? Basically, in 401k, most of the time, in most of the 401k, you'll have a limited choice of funds. Like here in this particular 401k, there is only 22 funds which are available, and these are the funds which are available in this 401k. Now, within this 22 funds, basically using some timing and selection of funds, I invest so that one avoids negative periods and try and make more money than the market makes, provided you have good funds. So these are the 22 funds. So what is the process which is used for this? Basically, uh, it's a very simple thing which all that I use is basically a momentum ranking. So momentum ranking is basically TI42. And what is TI42? TI42 is average C4 divided by average C42. So you're basically ranking funds by momentum. Now this is the number one ranked fund currently. As of now, I am 100% in cash because the fund which I was invested in, a BTTX, it's dropped in ranking, and I sold it much before that because the market breadth started deteriorating, and as a result, I have 100% cash position. But this is the fund which is now number one ranked. This fund is basically the one, if I was to buy, if I had like, and if I thought the market was going up, I'll be buying currently. Okay. Now, based on whatever is the choice of funds which you have, what you will notice is if you look at their performance over a longer period of time, like say if you take this 22 funds and look at their performance over say 5 years or 3 years or every bull move in the last 10 years, you will see that out of the 22, only 2 or 3 funds actually outperform anytime there is a bull market. Rest of the funds don't even do anything, in the sense that they will be even underperforming the market. So given that, there is no point in holding multiple positions. You have to be in the best performing fund. If you are in the best performing funds, once in a while, you can hit a big jackpot and you can make a lot of money, because the best performing funds will do significantly better than the other funds which you can hold. So basically, the timing element is based on market monitor. If market monitor is positive, or if it becomes extremely negative, then I get fully invested. And when I get fully invested, based on like last 15 years of doing this, I know there are a couple of funds out of these, like this IARX, in this entire 15 years of like looking at this FBTTX, um, FATX, which is a technology fund, FLSTX, and OddMax. These are the funds which at some stage have been ranked number one for a considerable period of time, or they are capable of making big moves. Okay, that means like these are the only 5 funds which are worth investing in: IRX, BTTX, FATX, FLSTX, and OddMax. Okay. Within these funds also, things change. Like OddMax was one of the best performing funds. If you look at it during almost for like 3-4 years, or this entire period, like there was no point in being invested in any other fund, because if you look at this particular period from 2003 to 2007, that's when the emerging markets make the biggest move. This fund went up 465%. As against that, no other fund, or the second ranked fund during that period, was FLTXCS, and FLSTX also made similar kind of a move, but OddMax was the best performing during that period. If you see here again, OddMax was one of the better performing funds, and then it dropped down in ranking coming out of the 2009 bottom. Similarly, you'll see that 2009 bottom, out of that, like FLSTX was up around triple digit, while since then OddMax has dropped. OddMax has done nothing. So the dynamic ranking allows you to be in the fund which is working currently. So FLSTX, FATX also sometimes can make a big move. If you see like here, obviously during the technology boom, FATX made like one of the biggest moves here, and also coming from 2009 bottom, it was one of the better performing funds, making a move up almost 200%. And time to time, it can outperform the market. Remaining funds don't matter. Okay, those remaining funds, they are just fillers. IRX also can make a big move. If you see here 2003, it made a big move from here to here. It's like 238% here. If you see, also it made a big move, 172%. Also during the bear market, when the market was going down, this fund was relatively better performing. So the ranking takes care of that. You know, look at currently, even though the market is down, IRX is number one ranked, while the others are at the bottom. Now, when the market becomes extremely negative, okay, and if I want to get invested, I always get invested in FLSTX. Based on past 15 years of experience, FLSTX has the highest probability of being in the top two funds, or number one or number two, whenever there's a bull market happens. And why does that happen? Because of the style of that fund. Whatever might be the style is basically is one of the funds which does best during any bull market. If you look at any bull market, it will do the best. Even if there is a short-term bull market, it will be one of the better performing. Now, if I buy FLSTX and if it doesn't do well and one of these 4 or 5 funds do well, then after 1 month I can get into that fund. There is a minimum 1 month holding period. Oddmax, emerging markets were one of the best performing here, but now emerging markets are no more, they are doing well, in fact, and they are underperforming. If you see from year to year, if you are invested in this fund, you net lost 2%. FLSTX, one of the better performing during that time, was ranked number one for many months. Okay, so that's the way this operates. Basically, no matter what mutual funds you have, that there are two elements. If you use, then you can reduce periods where you basically do there is a large number of months or periods when I'm just sitting in money market funds, and when market gets extremely oversold, if there is a 8% correction, that's the best time to get invested. So if you get into a fund like FLSTX, which tends to be better performing at market bottoms, then once the market recovers, you make money. Like say in 2009, 123%. Like, and you just had to be invested in FLSTX and Oddmax and do nothing, and you could like go do good money, because those funds were the best performing too during that particular period. Okay, so this is very simple if you understand. I've been like doing this for other people also. Is around 8 this thing 401ks are there, and it's the same method, which is like basically you rank it by TI42, and this is only weekly, it's not daily also, and look at the one which is ranked number one and go into that, hold only one or at best two funds. If you hold multiple funds, your returns will not be good. The reason being that if you see during the same period, supposing like if you look at a period like say this period where like say FLSTX made a big move, the number one ranked fund supposing was FLSTX, and it made like say here up to here period, like say it made around 135 move. I think Oddmax was one of the better performing during that period. So Oddmax was like say around up around close to around 60%. But if you were in some other fund, it would have been done even less than that. It would have done like better or worse than that. So being in just one fund, like say if you're in FBTTX that time, you underperform the market. So holding multiple funds is not something which I believe in. I always like to be in one fund. Super concentration is the way to do this, and these are mutual funds. These are not like individual stocks. So anyway, because they are holding multiple positions, there's no individual stock risk as such in mutual fund. Now the key characteristic of mutual funds you will see is, unlike a stock, if a stock is down a lot, there's no guarantee that it will come back. A lot of people might be still holding Alpha Natural Resources or some BTU or some other coal stock, hoping that it will come back. It is not going to come back. Individual stock may not come back, while funds, because they keep changing their investment, or they drop their underperforming funds and come, like say currently FLSTX is ranked last, but chances are that when the market recovers, it will recover because it would have sold the loss making position, it would have positioned itself for the new thing. So in short, if you hold one fund, your probability of making better money, making more money is better. Second, during the down periods, being in cash, which is like money market funds, is a better option than being fully invested all the time. Basically what you're trying to do is, like anytime there has not been a bigger correction here, but like anytime there is a correction, you're in cash and you get invested somewhere here because your market monitor indicates that period, or like on if you see during this per period, you'll be out in a cash, or there is this entire period in cash. So you're not really spending the time just recovering, because if you're not in cash, you would spend this entire time recovering. But if you are not, and you get invested on 10th of March 2009, then you are always going to make money. So you have to enter when the market has 8% plus correction. A. B. Always select the fund which has the highest momentum, which is by TI42, which is basically uh, trend intensity of 42 days now. And the third is only invest in one or at best two funds, because the more you invest in spread of funds, like say your number one fund makes 170% move, the number two, number three might end up making only 50% or 30%. So having two or three funds, you're like basically not going to be doing well. So that's the key. Now supposing you don't have telechart, and a lot of you may not have telechart, what do? You go to Google Finance, whatever the funds I have there, same funds I have put it into a portfolio. So you can create a portfolio and say these are my funds. Okay, once you have that funds, you go to any one of these symbols. Okay, you'll see that there is a 180 days of data here. Okay, so I will have to enter my password and all, which that's why. But if you see this particular thing, you'll see 180 days of data of this particular fund. Now what you can do is you can pull that into a spreadsheet, because what you need is basically, in order to look at, like say the TI42, in order to calculate the TI42, what you need is a formula which is average C. This looks like average C4 divided by average C42. That's the ranking, which is what TI42 is. So once you get this data into a spreadsheet from that Google thing, you can do this yourself, like little bit of spreadsheet maneuvering, and you should be able to, from 180 days data, actually you only needs 42 days data. You can do this using Google spreadsheet. So this is how Lemonade Strategy. Only look at it on a Friday. I don't do look at it intra week, basically only on the Friday, and then just keep being invested in the number one ranked fund, and that's the way you can do much better than passive strategies and strategies like mattress portfolio and some asset allocation strategies, which basically will put you into some very slow moving funds, and nothing will happen. As against that, this can turbocharge your returns. Not every year you will get turbocharged return, but anyway you are avoiding negative years, you are avoiding all the other problems, and once in a while you will get very good returns, because if the market corrects, supposing the market corrects 20%, there is a very good potential that you will make around 60-70% if you choose the number one fund, because that. And that, don't go by what I say, you can figure out this yourself by going through this past data and see every time there has been a 20% kind of a correction. Like out of this was a big correction, and out of that this fund made like around 139%. This was a big enough correction, and if you see here, like this fund made around 40-50%. This was like minor correction comparatively. This fund made like 40-50% return here, like out of a minor correction, and the fund still made like a good return. So if there is a bigger correction, obviously, like say if this was a bigger correction, and you'll see that the fund made 23-24%, while the index would have made only 8 or 10% return. So this is how you can turbocharge your returns, by doing some little bit of market timing and little bit of fund selection, and avoiding negative periods in the market. And then compounding takes care of rest of the things. So because if you compound, you can always do well, if you, as long as you avoid the negative periods. If you don't avoid the negative periods, then you'll be sitting in something like FATX during this entire period, and then this entire period is wasted as far as you are concerned, because you are still in FATX at this price, and then you spend 3 years coming back. As against that, you're in cash here, you have all your money, and then you use this and you're back 175% your return here, as against somebody who's sitting there passively and holding funds. Obviously the strategy is not for everybody, because this requires some amount of effort to understand and to do it regularly and to have confidence in it. If you don't have that, then anyway you will be like many other 401ks which are just basically riding up and down and nothing happening in them.